Greetings, everybody. This is Lesson 5, Financial Statements, also Chapter 8. Now, question 4. Which of the following statements is true? And the answer is 4. None of the above 3 statements are true. So what are these 3 untrue statements? 1. Only sole proprietors need to report business income on their personal income tax returns. That's a lie. 2. Only partners must report business income on their personal tax returns. Second lie. 3. Sole proprietorships, partnerships, and corporations are identical in terms of taxation of owner's income. That is the third lie. Question 26. Which of the following is the generally accepted accounting principle, GAAP, which determines what amount will be recorded on the company's balance sheet as the value of a building at the time of purchase? And the answer is 4, the cost principle. All right? It is the cost principle, which is the generally accepted accounting principle, determining the amount recorded on a company's balance sheet as the value of a building at the time of purchase. The cost principle. Remember that. And I'm on page 2, by the way. Question 29. The book value of an asset can be best defined as, and the answer is 1, the purchase price of that asset less any depreciation taken to date. So book value is basically purchase price minus depreciation. Question 34. An investment corporation purchased an apartment building on March 31st, 2003 for $2,800,000. Of that $2,800,000, $1,700,000 was attributed to the building and $1,100,000 to the land. Depreciation was to be claimed at $50,000 per year for the life of the building. The building component of the property was valued on March 31st, 2013 to be $2,400,000. What would be the net amount of the building appearing on the corporation's statement of assets and liabilities as of March the 31st, 2013? And the answer is 1,200,000. So let me see the building here. It was assessed. Okay, this was back then, 2003. The building was 1,700,000, and so that was 10 years ago. And now it's 2013, so 10 years and 50,000 per year. So 10 years, 50,000 per year. Let me see. That's $500,000. So basically it's 1,700,000 minus 500,000, which just comes out to 1,200,000. That is the answer for question 34. Question 37. To calculate income taxes payable for a corporation, depreciation, this is 1. Depreciation expense cannot be treated as a deductible expense. So if you're doing your income taxes for a corporation, depreciation expense cannot be treated as a deductible expense. Is that right? Depreciation expense cannot be treated as a deductible expense. But there is a way for deducting. I think it's what it calls CCR, something like that. We will find out. Question 75. To calculate income taxes payable for a corporation, 1. Depreciation expense cannot be treated as a deductible expense. Depreciation expense cannot, no, be treated as a deductible expense. Wow, how many times are we going to do this? Question 110. Which of the following types of organization is a separate taxable entity? And the answer for this organization, this is separate taxable entity, is 4, a corporation. Corporation is a separate taxable entity. Everybody say it. A corporation is a separate taxable entity. Corporation, separate taxable entity. Question 159. The practice of recognizing expenses as they are incurred rather than when they are paid for is the characteristic of, so this is when the expenses occur, not when they're paid for. So the answer to 159 is 3, the matching principle. Matching basically means you record your expenses as you are incurring them. So that's the matching principle. 159, the answer is 3. The matching principle, that's when you recognize expenses as they are incurred. Page 4, question 198. Which of the following best describes the effect that profitable operations have on the balance sheet of a business? 198, and the answer is 1. Owner's equity is increased. So that if you have operations that are profitable, how will that show up on your balance sheet? And the answer is 1. The owner's equity will be increased. You got increased equity. Things are looking good. Question 212. Which of the following statements is true? And the answer is 2. Both sole proprietorships and partners must report business income on their personal tax returns. So you got that? We got both sole proprietors and partners must report business income on their personal tax returns. 220. Which of the following would not be included in a statement of profit and loss? And the answer is current liabilities. You do not put current liabilities on a statement of profit and loss, but you would put 1, depreciation, 2, rental revenue, 4, interest on mortgage. You put all those things, but you do not put your current liabilities, number 3. And then we have happening here, page 5 with question 221. And the final value shown on a proprietor's income statement is, number 4, all of the above. And what are all of these above things? 1, known as net income, final value. 3, equal to taxable income plus capital cost allowance less depreciation expense. So we got the final value on the proprietor's income statement is equal to taxable income plus the CCA, which is capital cost allowance, minus the depreciation expense. And then 3, the difference between revenue and expenses for 1 year of operation. So it's all of the above. That's the answer for 221. 222, which of the following statements regarding income statements is false? And the answer is 4. It is always determined on an annual basis. That's not true. Income statements not always determined on an annual basis. 4 is false. The rest of these are true. 1, it's also known as profit and loss statements, income statements, that is. 2, it's a listing of the revenue and expenses of a business enterprise. And 3, it may include depreciation, revenue, and the cost of goods sold. All those things are true, but it's not determined on an annual basis. That thing is false. 296, which of the following transactions does not affect the amount of owner's equity? And it is for purchase of assets by the business. So you buy something like furniture, etc., for your business that does not affect your equity. But all the other things do. 1, investment by the owners. 2, personal withdrawals from the business. And 3, net incomes earned. All those things affect your equity, but not the purchase of assets. And page 6, 315. Which of the following is a liability on a financial statement? And the answer is 3, salaries payable. Salaries payable, these are liabilities on a financial statement, but not depreciation expense, accumulated depreciation, or both 1 and 3. No, it's only salaries payable. That's the only liability on a financial statement. Question 346. Which of the following is the generally accepted accounting principle which holds that all accounting information should be reported on objectively determined and verifiable data? For generally accepted accounting principle, which one of the principles holds that all accounting information should be reported on objectively determined and verifiable data? The answer is for the objectivity principle. So the hint you got there is that in the question it said objectively determined, so we got for objectivity principle. Question 357, statement of profit and loss measures number 2, revenues and expenses for a certain period of time. So the answer to 357, a statement of profit and loss measures 2, revenues and expenses for a certain amount of time. And we go to page 7 here, 386. Max Smith runs a small grocery store. The balance sheet as of March 31st, 2000 and whatever, shows land of 180,000 and building of 72,000 under the asset column. All right, he bought the land and building exactly 3 years prior to the statement's date. Each year, Max claimed 5% depreciation expense. What is the purchase price of the land? So obviously, the purchase price of the land is going to be higher than, 252,000, isn't it? All right. Oh, he just said the land, not the other thing. So the purchase price of the land? All right. And the answer for 386 is the answer is 2, 180,000. So the purchase price was 180,000. And after 3 years, the land is still 180,000. Okay. Question 387. Which of the following would generally be found in the current liabilities section of a balance sheet? And the answer is 4, all of the above. All of these things would be found in current liabilities. And what are they? Number 1, current portion of long-term debt. Okay, so long-term debt will be a liability. 2, property taxes payable. Yes, property taxes will be a liability. And 3, income taxes payable. So income taxes are also a liability. 396. Which one of the following will not be found on the balance sheet of a corporation? And so the answer is 3, names of the corporation's shareholders. All right, so shareholder names are not on the balance sheet of a corporation, but all the other things are, such as 1, number of shares issued, 2, original cost of the property owned by the corporation, and 4, retained earnings to date. Those will show up, but not the names of the corporation's shareholders. 409, which of the following best describes shareholders' equity? And the answer is 1, share capital plus retained earnings. Which of the following best describes shareholders' equity? Equity is number 1, share capital plus retained earnings. Share capital plus retained earnings. And 410, ABC Inc. paid $155,000 for an asset on which the Income Tax Act allows capital cost allowance, CCA. The asset was purchased 5 years ago and will be disposed at the end of this year. How much CCA will be claimed by ABC at the end of this year? Well. So we got the question 410. The answer is $0. So ABC paid for an asset $155,000. It was bought 5 years ago. It'll be disposed at the end of this year. So you cannot claim. They already claimed it, right? They already claimed the CCA. So the answer is $0. Now we got, wow, page 421. We got this. We've got this financial sheet here for Ambleside Productions. And the question is, this financial statement of Ambleside's Productions, and it shows the assets, shows the liabilities, shows the shareholders' equity, the total assets, total liabilities, and shareholders' equity. This financial statement is known as what? And the answer for 421 is 3. It's a balance sheet. Shows the assets, shows the liabilities, shows the shareholders' equity. It is a balance sheet. Question 428. Suppose XYZ Limited is located in a building that was purchased 2 years ago for $1 million. The building has an economic life of 10 years with no salvage value. Annual depreciation is calculated using the straight line method. If XYZ Limited has earned a net income of $450,000 this year and claimed $38,400 of capital cost allowance this year, what is XYZ's taxable income this year? Well, their taxable income this year is, number one, $511,600. And why is that? Do you know why? We'll have to make a note of that. Oh, you got that? You go to Mike and out of it, Mike. Croppers. So, now just from a quick look at this thing, they got net income of $450,000, so obviously that will be taxable. And just wait, is there capital cost allowance? Isn't that taxable? So that would be, so that's plus through $38,400, so that would be $488,400. So where is the other what is it, around 22 grand coming from? So anyway, that's from a calculation which I cannot do at this very moment. All right. And we got question 430 happening here. Current assets on the financial statements of a business include, number 4, none of the above. So what is this none of the above? Number 1, the owner's initial investment. Number 2, rents payable. Number 3, real property at its historic cost. So on a financial statement, the current assets, we don't bother with the initial investment. Okay, because that's a long time ago. We don't bother with the rents payable, the rent you must pay, because that's a liability. And 3, we don't bother with the real property as historic costs. We don't bother with that historic cost. We're only caring about current assets. Current. 10. Question 442. earnings on a company's financial statement is best defined as the number 3, accumulated total of the company's profits, less losses, less dividends since incorporation. So retained earnings. So remember this about retained earnings. This is number 3, accumulated total of the company's profits, less the losses, less or minus the dividends since incorporation. So you got your profits, and then you're going to minus your losses, and then you're going to also minus the dividends you got to pay out. 488, depreciation expense is 2, an accounting concept which attempts to allocate the cost of an asset over its useful life. So depreciation expense is 2, an accounting concept which attempts to allocate the cost of an asset over its useful life. As far as I know, depreciation is basically divided over a number of years, and each year you'll get a certain percentage.